Hi, my name is Steve Torsa. I'm the co-founder and managing director of Wholesale Investor. Obviously, I did the intro for today. My session is going to be around raising capital, and I think this is just such a key area for any company right now. And look, whilst the fundamentals of the process are still the same, what really changes is in your approach and the type of investor that you're targeting. So my session is going to be completely focused around that. Now, before I get to, so when most people think about the capital raising area, they're always thinking about the investor attraction part. Really what I want to do is I want to go through a few things before we actually get to that just so you can get this really clear from a fundamental process. So the first part is you need to understand. Now, my outcomes are going to be, the first one is understanding the emotions of raising money, the 7 steps, how you can have improved confidence around the capital raising process, and how to avoid some of the simple mistakes that most founders will make. So firstly, to kick off, the capital raising myths, and this is the stuff that we deal with most days of the week. And the first one is that it takes 2 to 3 months to raise money. Now, I'm pretty sure you're aware with everything that's happened in the last month, it is highly unlikely that it will take you 2 to 3 months to raise money. What people don't realize is that really when we host these workshops around the world, said really, if I'm presenting to a room of 100 people, often less than one or two in 100 have actually been able to raise capital from start to finish within a 2 to 3 month period. And that's what's really important to understand. Most people, you actually need to start planning a capital raising process for at least a 6 to 12 month period to get that capital raising done, right? So it takes longer than 2 to 3 months to raise money. And you've got to be aware. It's one of the biggest myths that we hear every single day. The next one is that advisors and companies are typically utilizing analytics for their capital raise. This is absolutely not accurate at all. In fact, most people are using sort of, Excel spreadsheet and email as part of their process. Most people aren't even tracking email, which is a surprise to me. And the last one is that VCs are the main investors. Now, look, VCs have played an incredible role in the Australian ecosystem as far as funding a lot of fantastic companies and a lot of unicorns and some of Australia's most successful businesses. The reality is they will invest in less than 1 in 100 companies. And so what the question has to become then is, who on earth has been funding all these companies up until this date, and who's going to be funding them going forward? The big question you're going to be having as a company that's raising money is, what is the next step for you and who is likely to be your funder? And I'll go through that in my presentation. So the first part you need to understand is I just realized that's twice now I said the first part. You do need to understand what is the process that you'll go through from a psychological perspective. So we want to help you understand that when you start out raising money, you always start off overconfident. That's absolutely everyone, me included. Now, as far as my background, I've raised capital, on several occasions now for Wholesale Investor. I've got shareholders that are from the VC industry. I've got an investment bank as a shareholder in Investec. I have international investment groups. In fact, I have shareholders from 5 different countries. Um, said I've been through this process a few times, and I've really learned the most for myself in going through this process over the last 18 months because I was being so heavily involved in it. Next one is, after you start out feeling overconfident, then you start to receive some rejection. And when you start to receive some rejection, then you start to have some doubt. And then as that doubt starts to accumulate and you keep on being rejected, then of course you start to have some fear. And this is 100% normal, right? And then as that fear really goes in, you're starting to worry, you see your cash burn going down, you're worried about your runway, you're worried about all these different aspects, right? And then what happens is you have an investor come on board, and then all of a sudden you feel bulletproof again, and the cycle just repeats. And absolutely, this can all take place in one day, right? So understand that this is just a normal process that you will go through in raising money. Now, when we speak to investors, investors always say to us the exact same thing. They'll say, Steve, I just want you to introduce me to the good deals. And my reply is always exactly the same, as saying, well, if you can show me what a good deal looks like, happy to do it. Because everyone has their perception of what a good deal is. It's very hard for me to define that for them. Most investors have got their own thesis, they've got their own sectors, they've had their own experiences, they've got their own background in a certain area that they know really well. So therefore, they have a different understanding of what is a good deal, very different to me. Then when we have companies will always say to us, Steve, I want you to introduce me to the good investors, right? So I can introduce you to good investors, but who knows if they will actually be interested in you? And that's the key to this whole dance, right? The whole dance is about how do you find alignment between company and investor, between the thesis and objectives and the vision of the company, and also the thesis and what an investor is willing to back. And that's pretty much the dance when it comes to raising capital. Now, I like to provide this as a story up front. Now, this is during sort of 2012, as you can see. So this isn't factoring what's happened to our worlds in the last sort of, 4 weeks. So Blackbird, when they were raising their first fund, and this sort of helps to put into numbers in that they had 500 meetings across a 22-month period. Just think about that, for example, and they raised $29 million. What I love to do is when I'm giving this demonstration, I love to break it down to a numbers perspective. So what it shows to you is that every investor that invests into their fund was basically on average investing about 300K. More importantly, it took them nearly 2 years to raise the money and meeting 500 people. Now, they were success stories before they started this. They were the cream of the crop when it comes to the Australian tech success stories at that time when they went down this path of actually raising this fund. And they still took them nearly 2 years to raise that money, right? And their average investment size was $300,000. That is super important to understand. But the other thing to understand is their conversion rate was 1 in 5, right? So they got 97 investors out of 500 meetings. But just put that into context about if that's what the most successful in Australia had to do to get their first fund away, imagine what it's going to be like for you as far as for your capital raising process and how many conversations you need to have. The next one I love to give is Patrick Grove. And you look at this as an example, right? He highlights an idea he was rejected 74 times for his story with iFlix. Now, that was for iProperty. For iFlix, it was rejected 115 times. Why I love using iFlix as an example is because he was already a success story at that part. He was already known for taking business models that succeeded in Western countries, overlaying it over Asia and making it a success. And yet, even though he'd already built a business that had a value of over $500 million. Now, just think about this. How many people in your life do you know right now that have been able to successfully build a $500 million business? And yet, this is still the effort he has to go to raise money, right? That's powerful to understand, right? So for me, I think this is such a good story for people to put into context about the effort that you will need to go through in raising money, right? And this, once again, this is not after GFC. This was just in normal period, right? So it's even harder at this time, but you've just got to understand for us as entrepreneurs and for founders, we're always up for a challenge, right? But you've got to understand the context of that challenge before you actually start. So I love to ask this question: is what is capital raising, right? And obviously, people always think about, oh, it's raising money to fund the growth of my business and so forth. What I'm actually referring to is it is just simply a sales and marketing process. Capital raising, that is all it is. It is a sales and marketing exercise. And so if you put into that perspective, I want to give you an analogy. Just imagine you as a founder, it's most likely you've got salespeople or business development people on your business. Imagine this. Imagine you've just recruited a new business development person. Imagine they're walking into your office, right? And as they walk into your office, you've got a desk and you point them over to your desk and you say, I want you to sit here. And when you say, I want you to sit here, you got a brochure on that desk. And your only instruction is this: go and make sales. What is their likelihood of success? Imagine there's no software, no process, no education, no systems, basically just a brochure and a pitch deck of how to raise money. That is how most people get guidance on how to raise money. They think that just the pitch deck will do it. They don't get any of the processes, any of the scripts, any of the systems involved in actually doing it. So likewise, this is why most of us find it so difficult. And actually most of us think that the raising of capital is a bit of a dark art, right? This mysterious dark art. But actually it's just a sales and marketing process. And the job is how can you get those processes and scripts which can actually help you be far more efficient and effective in actually raising money, right? So to me, I like to highlight this as an example because it really puts into perspective what it is, what it is you need to do for yourself when you go into your capital raising period. As much as you're going to prepare your pitch deck, you're going to prepare your deal room, you're going to get everything ready. But actually, you also have to prepare your process, your marketing process, and also your sales process. And you have to refine it. You have to test it, right? And this is the way we really want people thinking about it. I love to use this example when I do this in live events, right? Most people, they look at this and they see the Blockbuster logo and they start to smile. And what's interesting about when they start to smile about it is because most of us actually have good memories about going to Blockbuster, right? Typically we went there on a Thursday night, a Friday night, a Saturday nights with our family. We wandered around, we picked out videos, etc. And we had a positive experience, except for those, there's always someone in the room that's basically had a late fine that they didn't pay for, right? So what happened to them? Right? In 2004, that business had 85,000 staff and 9,000 stores. By 2010, it was bankrupt. The reason is because all markets move towards efficiency and people move towards efficiency. Now, I'm highlighting this because if your process is not efficient from the investor's perspective, then you are also going to have challenges. The reason I highlight this is because when we deal with investors, you know what their number one frustration is? Their number one frustration is how long it takes companies to get them their information thereafter, how long it takes them to answer their questions, and actually the fact of how much effort they have to go to get the information in the first place. The whole job is how do you simplify this and make this process easier for themselves? Now, I like to put up this slide as an example. This is the Dunning-Kruger effect, right? Now, just have a quick read through this, but it's basically, what it highlights is really that people often when they're starting out new with something, they have a lot greater belief in their skill set in something than what is actually real. Now, if you don't understand what all that means, here's a slide that perfectly demonstrates it for you. And this is everyone's journey with capital raising, not just me, not just, the person who's, listening to this in another country. This is everyone's journey. When we start out, we think, I'm so great. I've got the greatest business you've ever seen. I can't believe investors aren't throwing money at me. You've got all the overconfidence in the world. And it is very, very common to start out like this, right? And then what happens is as you go through the process, then all of a sudden that you start to realize that, you know what? I don't quite have the confidence that I thought I had. Where we want to get to people to is here. We want people to feel like they know nothing, right? And then you're utilizing the process and systems to actually improve it, right? But that is where that is where you are most open to learning and you're most open to engaging. But understand that if you haven't gone through the capital raising process, we understand the fears and emotions that go through with it. But you have to, at some point, you have to understand it's you, right? Not the investors, not the people you're dealing with. It's you, it's your process, and it's your company, right? So you always got to take it on your shoulders and understand where you're at in this actual process, right? Now, when we meet, you can always tell when someone's just started out in a capital raising process because of how they communicate to you about what they're looking to do. And when most people start out with raising money, their expectation that raising capital is going to be like this. They walk into a room, there's an investor with lots of money, and they're just going to be throwing money. They're going to be throwing money at them. So unfortunately, that's actually not how it happens. The reality is it can often feel like this, right? And so when you understand that, you understand that it's a process and it's also a numbers game, right? Now, for example, I'll have this conversation with companies. I'll say, well, if you've met with 50 investors and you've only had one invest, your conversion rate is 1 in 50. So their thinking is always, oh, I need to see more. I need to meet more investors. I need to meet more investors. What if you could actually improve your conversion rate from 1 in 50 to 1 in 5 or 1 in 10? What difference does that make? And that's where we want you actually to really be thinking about your capital raising. Now, in a coronavirus world and a post-coronavirus world, there's some other factors you really need to think about as well as part of this. But the core principles don't change. Number one, get ready. Get ready means have your information ready, have it easily ready so that an investor can access it like that. You want them, and I'll go through this in a second. So when you stay ready, always be raising. Right. So now there's called, basically agile capital raising, your ability to consistently raise money, and the importance of that is what happens typically in a capital raising is that a founder will allocate months to actually do it. When they do this, they often take themselves out of the business. And the challenge with taking yourself out of the business is that it can actually impact your revenue. You can miss out on opportunities. You can miss out on strategic opportunities. Typically when companies go through a cap raise, often they have the issue of staff leaving, right? Because it's consuming your time and consuming your energy. right? So get ready, stay ready, always be raising. And the final part is the most important. Get to the fastest yes or no possible, right? And the reason you want to do that is the worst thing to do is to be dragged out for 3 to 6 months with a potential investor, right? Because they don't have their information or they're waiting for information or you're going back and forth on different questions and so forth. If you can systemize it in such a way where it's efficient for them to get the information they want, you can get fast decisions. Now, none of us want a fast no, but I can promise you a fast no is better than a drawn out 3 month long no. The way you've almost got to think about it, and I heard this from a podcast with the Atlassian COO, he thinks about whenever he gets asked a question, he thinks about it's like a bug in the system, right? He feels like the way they can make themselves the most efficient is by getting to the point where whenever their clients have questions, that they have to remove that question. And that's almost the way you've got to think about your capital raising. And I'll give you an example of how I did that later down the track. Actually, this is my example. So when I was raising money, one of the questions people kept on asking me is, oh, can you tell us about your investor database? And so what we did is we just did a survey of our database so that we could get the answers, right? But this is important for you. I'm not going to spend too much time on this, right? But this was important for you. Now, this was done before COVID-19 launched on us all. So this was sort of the perspective of what investors were looking to do at that time. Now, this will still have relevance, right? Because there's obviously investors still active in the marketplace. Those sectors will still be of interest. In fact, technology platforms are becoming more important than ever. Healthcare, biotech have obviously done well in this period. Renewable energy, clean, not that much impacted by this, and fintech has become a lot more prominent as well. So, said a lot of that, and same with AI, deep tech. Said a lot of those areas said they haven't been too impacted by this at the moment, right? But there's obviously been some that have. Now, what's really important, and I'll highlight this, right? So whilst I've got this investor slide, I'll let you sort of absorb some of the information. I would really like to highlight that what changes in this period of time is that the investment, the money becomes more strategic and more aligned. So if you're dealing with investment groups, the first thing that you want to understand is how they are aligned already with your current strategy. When I say aligned, are they already generating revenue in the area? Like, what is the value add that you can potentially add to what they're doing, right? Because the more aligned you are, the more likely you are to receive investment. What disappears at this time is, it's crude, but it's accurate, is the punt money, right? So what happens is when people get bullish in a certain area, when you have markets rising for a bit, people do have spare capital. So what happens is they think to themselves, well, look, I'm going to allocate 25K, 50K, 100K to certain investment opportunities, and I'll see how they go, right? I've done well off a few investments. I've got some money, which I can. So what happens is that money starts to disappear, right? So what that means for companies, you have to work harder and harder on the momentum, because that money, that's the punt money, or the money from high net worth that would come in, that would actually help in building your momentum in your capital raise, right? Now, what you have to do is you have to focus on alignment of interests, right? So it's very, very important to understand is how your opportunity aligns with the investor that you're actually dealing with. So I hope that sort of helps clarify what changes in this period. Now, the reason I know this is from the GFC, right? Wholesale Investor launched in the GFC. For the first 5 to 6 years of Wholesale Investor, that is all I saw. There was no such thing as the punt money of investors going 15. Actually, there was one industry that had that: resources, right? In that period, people were always punting in small cap resources stock because it was so common. They'd grow them out of nothing. They'd bring out nothing. They'd find a bit of dirt. They'd put in 5 million behind it. They'd list on the ASX, and away they go. That's where that sort of money was going at that time, right? And then obviously we started to see it come over in 2014, 2015, and we've had the benefit of that for the last 5 to 6 years. It's important for you to understand that that money disappears at this point and money becomes a lot more aligned. So I hope that helps you. Okay, so now let's go through the 7 steps. Now, moving through this as quickly as possible. I do have a longer version of this video on YouTube, which you can look at sort of following this event. Okay, so set up and frequently asked questions, I'll go through in a second. Inviting investors. Okay, so here's your high level. Now, the only part I want to talk about, right, is the manufacturing serendipity, right? I will go into the rest in detail, but just what I think is really important about raising money is the manufacturing serendipity, right? Is your way of how do you make yourself more visible to an ecosystem of investors to find yourself the right type of investor for you? Or how do you get introductions to an investor that's going to be aligned and suited to you? Or how do you get yourself awareness so that that type of investor can find out about what you're doing? And this is our job as founders. Our jobs is to make ourselves as most visible as possible to attract the interest that we need to get the capital that we need for our business. It is hard work, but it's actually just our job, right? It's part of what we have to do. And you need to know that if you've got a 12-month runway, you need to start raising money right now. That is fact. It's in every single conference it's been taking place. They've been discussing this. Said in the next 6 months will be the greatest rush to private capital that we have ever seen. So you need to start working on this right now. So set up an FAQ. Let's go through it. So this is my personal room. This is my personal structure, right? So the wholesale investor room over here, I've got a basic pitch deck and effectively a term sheet in there. And also I've got just some high level information about our investors. In the financials, I've got just simply the last 3 years of financials for the company if someone asks. And then the DD room, I've got all the information available in the DD room for a more. Now, most high net worth investors will be just interested in this, right? But if you have some more strategic investment groups, they may want to get access to the financials. And if they're looking to take a larger stake in the business, then they may want to get access to the DD room. So the simple rule of thumb is this: high net worth investors typically have a quantum, an amount of money that they want to invest into your business. More strategic investors have a percentage in mind, right? So I hope that's helpful. This is what a DD room looks like when it's filled. And this is what my pitch deck room looks like. Okay, you can see I've got the different items in it. Now, this is in my platform, CRISP. Now, CRISP stands for Capital Raising Intelligent Investment Secondary Platform. So we've set this up to be an end-to-end solution for raising money. Now, with this part, this is important to understand, right? One of the processes we set up through our sort of capital raising success program is really making sure that you have the right frequently asked questions set up for investors. Now, I set this up for myself so that all my questions are answered before an investor even asks them. And that's where you want to get to with your capital raise, where you're answering all your questions before the investor even asks them, right? The way you simply invite an investor is I've kept it simple, straightforward. One of the reasons we started doing this, providing a whole bunch of templates for our clients, was that we got frustrated when we'd see our clients sending 3 and 4 page long emails with 5 documents attached to it, knowing that that's going to turn an investor off. So we decided to provide templates to simplify and streamline the process for our clients, right? And those 2 examples of one is an existing investor, one is a potential investor. Okay, now we're sort of fair way into the chat, and this is the part which most people are thinking about. Now, obviously, I've spent a lot more time going through all the information before getting here, but attracting and discovering investors is a key part. So we obviously recommend building a registration list of investors. Obviously, your board and advisor networks are always important. Suppliers and customers is one I like to talk about the most. You know, I do have for myself, I have a supplier as a shareholder, and I have a customer as a shareholder, right? And those relationships were built over time. But it's important to know most people don't think about their suppliers or customers as potential shareholders, but they're very strategic often to your business, right? Existing networks and networks of friends. And then the last one I'll just mention, you know, this is the most said at this point in time. This is sort of those last 2 really become, you know, actually all of them are important. And for you, you have to go down every path to attract it. But said in this environment, your investor is more likely to be aligned and strategic. Okay, so external promotional services part of it because you've got to uncover that potential investor. Okay, so discussions and presentations to create more visibility for yourself in the pre-launch of your capital raising. So we always encourage companies to do a pre-launch process. That involves meetups, that involves pitch competitions, media. I love working with companies that have received some sort of media attention, right? And the reason for that is because there's a subconscious impact to it. If a company's been seen in the media 5, 6, 7, 8 times, it makes it so much easier when you promote it out to an investor and they've already got a brand recognition with that company. We find that is always helpful. And then the virtual showcase presentation, But this point right now, this is the way for you. I said for me, it's exciting because what it means is it gives global distribution and it breaks down the borders between companies and investors, right? Because you can create. This is one of the most exciting opportunity times for investors that are proactive in the private space. Because you've got to remember, a lot of investors got cashed up before, or a good portion of investors were cashed up prior to this period with the expectation that something was going to happen, right? So for them, this is their time for deal making and networking. Okay, the 7 steps, continuing: activity tracking, momentum creation, communication, and then the rolling close. Okay, now, as I mentioned, what's really important about this for the frequently asked question process is that I love analytics. I love to know what's happening in my deal room at all times. Now, if you notice my top 4 questions here, what's really important about this is that when you start in a capital raise, you often don't know what investors are thinking about your company. You don't know what's of most interest to them. You don't know what they're focusing on. You don't know what's driving them for their investment. For me, I've got all the data on it. I know exactly what is the most key components that investors are thinking about at a holistic perspective about my company when I go into a capital raise. And what that provides me one of the most important things that you need as a founder going into this process, which is confidence, right? Now, to give you some further data, the way the platform's set up is that it tracks every single activity in a certain way. So I've got a dashboard of people that are most likely to be investors in my business based on their activity inside my deal room. Now, that's important for me because I want to know who are the most active investors and who are the least active investors. If you're just sending an email to an investor and you've got no visibility over what's happening with that email, that is your biggest opportunity loss for gathering intelligence and understanding. One of the reasons I knew that Investec was so interested to become a shareholder was because I had email tracking software and I could see how many times they were opening up every email. Now, this is another important part for me. So when I go into, sorry, I just have a quick drink. When I'm going into conversations with an investor, I love to know what sort of questions are of most interest to them. So those frequently asked questions I showed you before, I've got full visibility over what gets clicked on during the process, right? Now, why that's important for me is typically those questions that they click on, even though they're already been it, that is saving me answering the exact same question over and over. So when you're typically going to a capital raising process, most of your meetings can end up being anywhere from 2 to 3 hours because you're answering the exact same question over and over, right? I'm trying to make it as efficient as possible for the investor to get the answers that they want as fast as possible. So my conversations are 30 minutes, right? So you can see in this scenario, you can see all the different questions that were clicked on before I went to have a conversation with this potential investor. Now, when you're creating momentum, this is one of the key parts right now. I said for creating momentum is going to be harder than ever. You'll have to work 3 to 5 times harder than what you've ever worked before to create the momentum you need to complete your capital raising. Right now, these are all the tools that you have at your disposal. You need to do virtual showcases. You need to do webinars. You need to do conference calls. Emails are obviously going to be important. Webinars, videos, all that sort of stuff. You need to launch your capital raise, and also you need to provide progress updates. Now, we will be providing these slides as a resource, right? And the reason for that is we just want to help you instead of creating a framework for yourself in how you actually go about your capital raising. But as I said to you, if you are thinking about raising in the next 12 months, you need to start that process now. Communications. Communications, I always find the way you've got to think about it is investors, no different to us founders, they're basically borderline ADHD. You have to keep it simple and to the point, right? So you can see in this communication, it's really simple in that I'm highlighting that, like for example, in this bottom one, I'm highlighting that I want to have a brief introductory phone call, right? And what I'm doing is I am aiming to get a phone call and then I'm going to give access to my information. Simple thing, simple rule, right? But it makes your life so much easier because often what I found, if I just give access to my room, often there's no follow-up conversation going forward. Now, as we start to get to the end of this, I really want to go through what the investor psychological process is, right? So the first part is, okay, loss aversion. Now, this is even more true right now as investors are thinking, okay, how can I lose with this investment? Now, if you think about it, there's 4 ways that an investor can lose. Number 1 is money, right? And that's most people think, oh, they're worried about losing money. Money's only one of the 4 ways. Time, If they invest into your business, there's a certain amount of time that they're also going to invest into your business as well and tracking your performance, right? Third one is reputation, right? Especially for significant investment groups. Like I know with the investment groups I know that are investing to me, reputation is part of it as well, right? It's potential to lose. And lastly, that most people don't think about is opportunity cost. So that money that they're investing into you, they could invest into every single thing else, right? And what if it did better than what they're investing into you did? That's their opportunity cost, right? So you need to understand that from a starting point. Investors do not want to be the first one in, but they also don't want to miss out, right? You often hear a question from investors going, so who else has invested? Right? Or who else is participating in this round? Because they want to make sure that they're not the first ones going in. And this is a dance that you see some of the most brilliant people at capital raising can make. They can manufacture pressure at the same time whilst they're securing their first investors into a capital raise. Bandwagon effect. You'll notice in every media article about a capital raising, there is always a group of you've got one lead investor and then you've got investors that follow on, right? So basically that's obviously mentioned, it's called lead investor and then the follow on investors as well. And you find that more and more prevalent. There's actually very few lead investors at the moment. And there's a lot more follow on investors, okay? So the bandwagon effect is massive, especially in Australia, especially in Singapore, and especially in the UK. FOMO. So there's an interesting part in a capital raise where you get closer to the end. So let's say you pass that sort of 70, 80% mark, and then investors get the concern about the fear of missing out, right? Because you build up momentum, there's a bandwagon effect going on. They're not the first one in. And then they're thinking, wow, well, this other investor's involved, this other investor's involved. And then they're worried about the fear of missing out. And this is all the same, right? So just because it involved capital raising, just know that this is the same psychological game that's going on at the moment, right? Now, as I said, this may be less prominent than what it was 2 months ago, but you need to understand it's still a human emotion, right? The understanding of who else is going into it. But just keep focused on that fundamental of money will become more strategic and more aligned, and your job is to make yourself visible to attract that money, right? Key other things they're looking for is 5 to 10 times uplift. 5 to 10 times return. You hear a lot of investors say that directly, that they're looking for a 5x to 10x return from their investment, especially in early stage companies. I highlight this because you need to look at your valuation when answering this question. Can the investors coming into your business, what do you need to achieve for them to achieve a 5 to 10x uplift in your business? And then the impending uplift or exit is also another psychological factor. So you find some of the most easiest opportunities to promote might be a bit more different in this current environment, but pre-IPO opportunities are typically some of the easiest opportunities to promote. A pre-IPO means that they're just prior to going and listing on the Australian Stock Exchange. They're typically about 12 to 18 months out. So they're going down that pathway and they typically raise capital at a discount to what they're going to be listing. So investors know there's an upside and they also know that there's a potential exit, when the company lists on the ASX. Okay, so to finish off the common mistakes that founders make, firstly, overconfident, unrealistic. We talked about this before. You will absolutely make this. I could wake up and say this to you every single day. Don't become overconfident, unrealistic. It's just unfortunate. We are naturally optimistic souls. If you're a founder, if you've got any sort of optimism right now, think about it. The entire world right now is freaking out. There is hysteria on the news. I can show you news article after news article after news article. Governments are pumping trillions of dollars of stimulus around the world, right? And I swear to you, every single day, all I talk to is optimistic founders, right? And also optimistic investors as well. We are in such a unique space that you need to appreciate it. You need to appreciate the mindset. And even the founders that are going through absolute shit, that have had to fire 90% of their staff, can be still optimistic about their future because they're either pivoting, they're changing their business model, they're going to be doing something differently. Whatever it is, they will find a way to find a brighter future, right? It is literally, I just cannot say enough about the resilience that sits inside the DNA of founders. It is one of the things that I love and am truly passionate about, the most. I love trying to uncover that. Unwillingness to invest in the process. Whatever you need to invest in this is not a part-time job. This is a full-time exercise on your part. You need to go all in. It's not half in. It is absolutely all in this process. It could be a second job for you. You could be doing 6 to 8 hours. Go all in. The results will absolutely be there. That's you need to back your story, back your convictions, and back your strategy, and go all in on the process, right? And invest into it. I recommend do not rely on one existing investor, right? And the reason is because they may not want to follow on. They may have challenges in other portfolio companies that could be affecting their investment decision with you. That's completely fine, completely normal. It doesn't mean that they don't support you. They're not going to champion it. They're not going to help you. It's just for whatever reason, they can't continue following on investing. That's fine, right? Fine. Don't rely on them. Go on, always be, as I said, always be raising, always be looking to attract new investors into your deal room. And then the reliance on one potential investor with no time pressure. The single greatest mistake that I personally have made and that most companies make when they're actually raising money is relying on a potential investor with no actual time pressure. All right, so my lessons from a capital raising process is number one, education is super important. You need to be educated on what this process is. You need to learn, study it, right? For me, myself personally, I changed some simple things about my pitch deck, my process, and went from a 1 in 11 conversion ratio to a 1 in 4, 1 in 5. That is the difference that it can make when you get the education. And then also software is important. Obviously, I highly recommend using my own platform because I literally built it for the purposes of raising money. And so there'd be end-to-end solution. And I built it so that every founder that uses it can save a shitload of time, money, and cost in the actual process. And also we've built it in such a way so it makes it really easy for you to understand what's going on in your capital raise. So software is important. Process, we actually provide process as part of our customer capital raising success program. And then also investors, right? You need to get access, but you need to be diligent, you need to be proactive, and you need to be constantly looking for ways to drive investors to your deal room. In fact, what you should do is set yourself a KPI. Your goal should be, how do you get 50 investors into your deal room in the next 2 to 3 months? If you set yourself that kind of KPI, that's the kind of thing that can help you get momentum. And then when you do that, you analyze yourself, refine, improve, and then repeat. It's the simplest thing that I've learned from raising money. No different to what you do for a sales process for getting customers for your business, right? And in fact, what's really interesting is JD, who's talking about the sales part, said exactly, I learned a lot from understanding, from listening to that presentation, but analyze, refine, improve, repeat. Okay, the personal benefits goal. This is your entire outcome that you want every single time that you go into a capital raising from here. Confidence. That's what we all want. Because I absolutely know that you as a founder are starting out, you think you know what investors are interested in, but the truth is you have no idea. And you don't really know until 12 to 18 months from now as you start to get some actual visual data on it. And that's what I say, you've got to get that data and information on what's going on with your capital raise, because otherwise you've just got a perception about what you think people are interested in. And unfortunately, all human memory is flawed, right? So you need data to reference for when you're trying to get this information. So I've got a little bit of information about utilizing CRISP. Okay, we've actually got a full demonstration on our YouTube channel for us. I'm not going to go into too much information. All I'll say is go and set up a free account on CRISP, right? We've made it really easy for you to do it. Set up a demonstration account and actually have a play. We can have one of our team do a proper demonstration with you. So, but all we want you to do is when you raise money is this. We want you to raise capital with confidence. We want you to utilize analytics so you can actually increase your conversion rate. We want to save you time, because the biggest thing is you will spend 3 to 4 times the amount of time that you need, more than what you need to spend, if you don't have the right process in place. If we can save you time, it is far more important. It's like the value of that goes beyond just the actual capital raising process itself, right? And then also what we're doing to help really on the confidence side is we will provide you with our proven templates, processes, and systems that we've used ourselves so that you can use that, overlay that over to your capital raising strategy. These are some of the features that are coming. This is my information. So feel free to add me on LinkedIn. I'm always posting about stuff related to raising money, and it's just stuff that I find interesting in this specific area. I said it's literally what I focus on the most, and actually it's what our entire team focuses on. As a final thing, I'll just repeat what I sort of started off with. Right now is going to be the biggest rush to capital that we have seen in private capital history in Australia. And the reason being is we've never had so many companies in the ecosystem. Your job is, how do you make yourself more visible? How do you stand out? How do you capture the attention of potential investors? And then when you do capture their attention, is how do you understand how you're strategically aligned to either how they've previously generated revenue, or how they're generating revenue for their existing investments, or how you're aligned to their existing investments, to the existing business that they have, or how can you leverage their skills and networks to generate more value in the opportunity? Just think about it from the point of view is, how aligned are you to either that company, that investment group, or that in person that's looking to invest in your business? The more you can see that alignment, the more likelihood you've got a potential investor on your hands. Just understand that capital is more strategic and more aligned at the moment. I really thank you for the opportunity to talk to you today. I hope you're enjoying the entire different presentations we've set out for today. And I look forward to sharing more information with you in the future.